Morning, Market Chameleons. How you doing this morning, Dima?
Good morning, Will. How are you?
Great. All right, we're going to get to some new features, so let's get the disclaimer out of the way real quick.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker-dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help provide you with guidance, help answer your questions. There's the disclaimer.
Excellent. What are you seeing this morning, buddy?
So we'll take a look, see what's going on in the pre-market hours. And after that, I'm going to move on to some of the fundamental features. We'll take a look at some new features, and then I'll do a couple example stocks. It may be based on some of that analysis or assessment of information. We'll see if we could structure an option strategy to capitalize on a potential outlook.
Excellent.
All right.
Very cool.
So first, we'll start out with the pre-market report, and these are stocks that are trading in the pre-market hours. We have the most active stocks, the biggest percentage gainers, biggest percentage decliners. Let's take a look really quick at the higher market cap stocks and take a look if there's anything interesting going on there. 5 made the percentage gainers list, 44 on the percentage decliners list. From that perspective, looks more like a bearish bias at the open. Not a lot going on these lists. Maybe, I'm just seeing maybe Tesla popped up 1.2%, 182,000 shares, but low volume on this list. We usually don't go to the percentage, we can't make it through all of them, but one of the ones that popped up, QS, QuantumScape, down 7%, and that's, they did announce some news. Looks like they're doing a secondary public offering. So I'm going to just click on that. And I just want to mention it because one of the, we always go look for new data sources to add to the platform and to add into your analytics. So in this case, the stock is reacting to some news that they're going to do a public offering. In other words, they're going to sell more shares to raise capital. And, this happens a lot, and we're going to start capturing this data. And the effect of it is that you're going to start diluting shareholders, right, by issuing more stock. So now there are more shares outstanding. They do that to raise capital to help, fund whatever project or their operating expenses. And you could kind of go in there, read more about it. And the idea is, well, when they do that, we'll start capturing and see what tends to happen to the stock. And that, big companies do that as well. Tesla also issues more shares sometimes if they need to raise more capital. If the markets are good enough, they could do that as well. Sometimes stocks or companies actually need to access the market because they're just running out of cash, or not making enough money. But the idea is to start tracking it and seeing what tends to happen to these stocks going out in the future. Does that dilution, have a longer term effect on that stock performance, or does the stock start to recover? Because the idea is sometimes they might actually take that capital and put it to good use and get a return. So just wanted to mention that. But since this is, this is the specific news it's moving on, while I'm on there, let's just see how this stock tended to behave after opening down. And here I'm just looking at the 12 largest down moves at the open in the last 3 years. Okay, so we're looking at 12 largest down moves, opening gap moves at the open in the last 3 years, and what the stock tended to do afterwards. And of course, there is news out there, so you got to take that into consideration. But if we just take a look from a historical perspective, these are the dates that the stock opened gap down. their notes, if there are any press releases or their news on the stock, or if the stock market was down that day, you could kind of hover over it. But these are the opening gap moves to the downside. So you see here March 12th, opened down 5%, February 23rd, down 5.9%. If we take the average of the 12 largest, down 8.6%, which right now it's down 6.1%, so a little bit below the average, but within this historical range. What did the stock do? How did it behave after the opening? So let's look at a historical return distribution. After opening down, from the opening price to the high of the day, the average was 8.4%. The average move up 8.4%. From the open to the low of the day, the average move was down 8.9%, a little bit more skewed towards the downside. From the open to the close, it was 50-50. Half the time it finished higher, half the time lower, for an average loss of 1.8%. But the intraday volatility, okay, moving from the open to the close of the day, the average move up or down, right, in either direction, 9.7%. So you could see very volatile, the stock, almost, it could go either way, 10%. It does look like historically, now again, this is different news than history. This doesn't mean that they were issuing secondary offerings each of these days. It just happened that they were down on some news these days. But from a historical perspective, it looks like, the stock almost 50-50 coming out, going up or down, but the up moves looks like did exceed the down moves, because on average it had some gains coming out. So this is just really quickly an example of a historical return distribution after opening down in this QuantumScape QS stock. But I just wanted to bring it up because it did move on a certain news event that I think as we go forward, we're going to start capturing that and trying to also compile the historical data to get more insights on this specific type of event. Let's go to the unfiltered report. We do have a couple stocks, low cap stocks, 15.4 million. That's moving BNTC up 137%, trading 13.8 million shares. You could kind of go over it there and read the headline news. That looks like a healthcare stock. TKAT up 28% on 500,000 shares. That's a $555 million market cap stock. You could kind of go in there, start looking through that, seeing if it's justified. But to save time, I'm going to start moving on to the next feature as well, unless you have questions on the pre-market.
No, it seems like you can move along, brother.
Let's take a look. Let's take a look at, I'm going to use Target as an example here. So stock Target, $188.04. We're going to first take a look at it from a fundamental perspective. And these are a couple new features we just released over the weekend. So I'm going to kind of go through them quickly, just describing what you're seeing. We're going to take a look at what we think the implied value of Target should be, or approximate the implied value. And then based on that, we'll form an option strategy. Okay. So profit margins for Target, we have 4 different ways to calculate their profit margins. And then we're going to take a look at each one. How does it compare to its historical profit margins and to the rest of the market? So we see gross margins in Target, 29%. In other words, for every dollar in sales that they generate, right, it costs them approximately 71 cents to make that. So they keep 29 cents. Okay, so they keep 29 cents for every dollar of sales that they generate. So 29% profit margins. The rest of the market, 32%. If we use the S&P 500, So you could see that's that's below the S&P 500 by 3 clicks. And their profit margins from year to year are pretty stable, around 30%. So they don't jump around. So that's the good news, that it's been pretty stable, right? They're around 30%. Operating margins. So operating margins will take, that's if we look at, for every dollar in sale that they make, it costs them, like we said, 71 cents. But then if you take out the salaries, the marketing, research, and development costs that also go into their core business, they're left with 7 cents in profit. So that's 7 cents compared to S&P 500, 12%, operating margin 7%, S&P 500, 12%. We see they're 5 clicks below the rest of the market. But again, the good news is that on that is below the market, but the good news is that it's been kind of stable around there. So it doesn't like fluctuate a lot, right? So it's got a little bit more of a stability, or hopefully predictability going forward. EBITDA. So these are earnings before interest, taxes, and depreciation, amortization. So of course, besides their core business, they might have other kind of profits in there from certain investments. Maybe they owned stocks or bonds that they sold, maybe sold off, they're buying, I'm sure, assets, selling assets. So these are their total earnings. So that's 10% versus the S&P 500, 18%, 8-click difference there. But again, it's been pretty stable. They're around 10% year over year. Net margins, that's just, how much earnings do they have after everything? We take out everything on net, what's left to the shareholders, 5% net margins in target versus S&P 500, 8%, 3 clicks difference. And, that's also been pretty stable there. So we could kind of see that their profit margins are not as good as the S&P 500 on average benchmark, but they have been pretty stable, year over year. Let's take a look at growth rates, right? Because besides their profit margins, are they growing? So here's target on revenue. So these are total sales, right? So total sales last year, 20%, they grew 20% in revenue. You could see here, up 20% on the 3-year average. So if we took the last 3 years, year over year, on average, they grew at 9% per year. 5-year average, 5%. So at least going 5-year average, 3-year average last year, that you could see here that the growth has been accelerating, which that's pretty good news, right? You want to see your top line growth kind of moving higher. So that's on the revenue side. That looks good. And if we compare that to the growth in the S&P 500, 4-year average, 4%, 5-year average, 5-year average, 4%, 3-year average, 5%. Last year, because of the coronavirus, we're down in the S&P 500. So from that perspective, it's growing faster year over year than the S&P 500, that's a good sign. Even though profit margins are lower, their top line growth, they're expanding much faster than the S&P 500. Net income, we see here, 5-year average growth 5%, 3-year average 14%, last year 33%. So that's been accelerating. And if we compare that to the S&P 500, doing much better from that perspective. Operating income, so these are just the income that they're generating from their core business, right? Not total income, but just from their core business. 5-year average, they've been growing at 6%. Last 3 years, that started to accelerate it at 16% last year, up 40%. So in each of those metrics, that's beaten out the rest of the market, S&P 500 versus growth. So we looked at profit margins, a little bit below the rest of the market, but there's stability there. But growth, looks like it's better than the rest of the market. Valuation, let's see how they're valued versus the rest of the market. So price to earnings, so that's if we took the entire market cap of Target and divided by its net earnings, that's left over to the shareholders. Right now, that ratio 21.8 PE versus the S&P 500 38.9. So its valuation is not as rich as the rest of the market. So we could see here, though, compared to its 5-year average, 3-year average, it's traded at 15.8 PE, 3-year average 17.5 PE, 21.8 PE versus the rest of the market. So it's been, the valuation has been climbing a little bit. Again, though, there have been growing as well. So that's getting priced in. How does that compare to the S&P 500? So we see 5-year average, S&P 500 26 PE, Target 15.8, traded at a 39% discount to the rest of the market. 3-year average traded at 37% discount to the rest of the market. Now we're at a 44% discount. So even though the valuations, what this is telling us, even though the valuations of Target is higher than historicals, but relative to the rest of the market, it's actually at a bigger discount than it used to be, right? So right now, 44% discount to S&P 500 versus 5-year average 39%. Price to sales, this is a valuation based on if we took the entire market cap of Target divided by its trailing 12-month revenue. How does that look? So here currently we're at 1%, at a 1 ratio, 3-year average 0.7, 5-year average 0.7, a little bit higher than the 3 and 5-year average, but when we compare to the rest of the market, it traded at a 72% discount, 71% discount last 3 years. So right now it's at a 66% discount, so not as high a discount price to sales. Just to hurry it up, price to book and price to EBITDA, same concept as these two, except then it's looking at price to book value, price to earnings before interest, taxes, and depreciation. Last one, yields. I'm just looking at the time, and let me know if you have questions, Will, but I'm just going to hurry it up so I could go to the options chain. So if we wanted to look at, well, if you bought all the stock in Target, right, its entire market cap, and then you kept all the earnings, right? If you just kept all the earnings based on the trailing 12 months, what would that yield you, right? How much return would it be? So that's the earnings yield here. That's 4.6% based on last year's trailing 12 months. 3-year average has been 6%, 5-year average 6.7%. And with interest rates going lower, you would expect these to kind of decline as well as the valuations go up, right? But if we compare that to the S&P 500, 4% on 5-year average, 3.8% on 3-year average, 2.6 currently. So that's still 2% better earnings yield than the S&P 500. Okay. Operating yield. So that's just taking the operating profits. That is a 7% yield compared to 3-year average of 7.1% and 5-year average 7.1%. So that's very close, to its historical average. But we see the S&P 500 3.6%, which declined from 3-year average of 4.9%, 5.4% on a 5-year average. In other words, right now, from your operating profits, the yield on the S&P 500 dropped to 3.6%, where we see historically, let's say it was like 5%, so that's 1.4% less yield. In Target, you're very close to its historical average. Earnings EBITDA, earnings before interest, taxes, depreciation. We're looking at a 9.5% yield versus S&P 500 5.5%. And we can see here 3-year average 13.3%, 5-year average 15.5%. This is the S&P 500 3-year average 7.2%, 5-year average 7.9%. So the yields have fallen as valuations have increased. Interest rates are lower, so valuations are increasing. You know, market is requiring a lower yield, but still pretty big difference between the S&P 500 and Target. So now that we got that picture, let's just take a look really quickly at a fair value, a potential implied value or fair value for Target using some of the data. And if we look at Target and we say, okay, if we use Target's historical multiples, right? So here, like a 3-year average PE of 17.3. If we use that, what would the implied value of Target be? It would be this. If we use the 3-year average of price to sales in Target, so 3-year average 0.7. If we use that, then this would be the implied value. We're doing the same thing with book value and operating income. Okay, so these would be the implied values if we use the 3-year average as our benchmark. What if we did the same thing but compared it to the S&P 500? So here, and then Target's P is 21.8, S&P 500 38. That's a 43% discount. Historically, the 3-year, based on the 3-year average, it traded at a 35% discount. So if we use that as our benchmark, this is the implied value. And we keep going down the line for each valuation ratio. And if we took the average of all these implied values, we're at 159.77, market 188.04. So based on those 3-year benchmarks, we're at a 17.7% premium. Again, these are estimates, right? You could remove, if you don't want price to book, you could remove that, rerun it, you know, because maybe price to book isn't as important. If you want to remove some of the other ones like PE, you could do that as well. So it's, or change the number of years. But I'm just going to keep it at the average here. So again, we're just approximating based on historical benchmarks going forward. That doesn't mean it has to be that way going forward. Comparative model. So what about using forward-looking estimates, right? So not, those are historical benchmarks, but what if we think, okay, well, Target is going to grow their revenue. You know, maybe Target's going to grow their revenue like we've seen in the past, and they're going to earn more money. So how does that compare to the rest of the S&P 500? So I'm going to come down here, and here are the inputs into this calculator. And we want to compare, well, in the next 5 years, we know how is it if we took Target and compared it to the benchmark to the rest of the S&P 500, where would it be priced at? So we're going to use 3 different inputs: operating margins, revenue growth, and volatility. So if we see that Target, these are historicals, right? So it's going to default to using historical numbers to see if they persist, how it would look, but you could change any of these. So if you think operating margin should be lower, you could change it. If you think it should be higher, you could change that as well for either the S&P 500 or Target. But here's how their operating margins look right now. Currently, it's at 7%, based on trailing 12-month SPY, 11.5%. So I'm going to keep that here. Okay, that's their operating profit margins. Revenue growth. Well, what about their growth rate? So we see last 3 years, the average growth rate's 8.8%, and S&P 500 4.3%. So I'm going to keep it at the 3-year average as the default, and saying, well, what if that persists going forward? And we see here the last year it's been climbing, all right? So it's been climbing. Volatility, I'm going to use that last, but the volatility is just comparing the risk factors of S&P 500 versus Target. So in other words, even if they were yielding the same and making the same amount. But if the S&P 500 is down 5% and Target is down 10%, obviously you're taking then twice as much risk in Target than you are in the S&P 500. So let's see how this calculator looks. SPY, if we bought all the shares outstanding in all the companies in the S&P 500, that would be $36.4 trillion. The trailing 12 months, the revenue was 12.2 trillion. Target, all the outstanding shares, $93.8 billion to buy the entire company. Its total sales, 93.6 billion, trailing 12 months. So what if we going forward, if we gave SPY a 4.3% year-over-year growth next 5 years, and we said that their operating profit from that revenue is 11.5%. So if we start here, next year, revenue grows 12.7. The following year, it goes to 13.2, 13.8. This is the 5 year. If out of this revenue, if we take 11.5% as profit, that's 1.5 trillion year one, 1.5 trillion, a little bit over that year two, 1.6 trillion year three. So if we took the cumulative operating profits for 5 years in S&P 500, 7.9 trillion. If we bought all the companies today, 36.4 trillion. So in 5 years, that's a 21.8% return. In Target, if we did the same thing and said, well, revenue would grow at 8.8% year over year, 7% operating profits. So the cumulative profits in 5 years, 42.4 billion. Market cap today, 93.8 billion. That would be a 45.3% return. So from that perspective, we could see here that for buying all the outstanding shares here in 5 years, if our assumptions, remember these are just assumptions going forward, based on those estimates, you get a higher return, right, than in the rest of the market, S&P 500, 21.8% versus 45.3. So if we priced Target its market cap to equal this 21.8, what would be its implied value? So the implied value 389.55 versus 188.404. So you could see from that perspective, if we just benchmarked it to going forward with the market, it's at a discount. Now, of course, any of these assumptions you change. If you go to a 5 year growth rate, 4.9%, let's say operating profits 5%, recalculate it, and it'll give you a different value. Okay, so let's just say I'm running out of time. Let's just say maybe this is too aggressive, and we give it a lower target and we want to let it play out for a year, right? So let's say we give it, maybe the rest of the market doesn't see it that way. More risk capital is flown into things like, let's say, digital coins, instead of Target or wherever else. Let's give it a more modest target. Let's say $210, right? 210. If just based on this, remember here, if we use these historicals, we're looking at a different valuation. But if we were using it going forward, let's say 210, just for the sake of demonstration, I'm going to go to the options market here. And if I give it, I think it's going to be 210 or higher a year from now, let's say by January 22nd. All right. So this gives us 212 days, trading days by January 21st. If we give it a target of 210, right, maybe what can we do to use the options maybe to capitalize on that target? This is an if, and guys, don't go do this. I'm just giving you this as a demonstration, okay? I'm not saying to go do this. So I'm going to look here from the perspective, I'm going to buy an in-the-money call. So I'm looking at the relative implied volatilities here, and I'm going to do the 180. So I'm going to say, let's say I buy the 180 call. And, if my target is 210, I might just sell that 210 call. Let's do that, the 210. So I'm buying this 23.55. selling the 210, 1095. I'm going to run that payout diagram. So here it costs $12.60, right? Midpoint is 1205. So you could see here, this is a wide market. Pay attention to that midpoint. You always want to get execute as close as you can to that midpoint. But 1205, if the stock goes down, whatever you're paying, 1205, 1260, below this, that's your risk. But let's say 210 is we hit it on 210 or above. Then that would be a $17.40 profit, or $1,740 profit for $1,260 risk, right? So let's just say in a year, that's approximately, if that happens, right? If we're right, if that happens, and we have a 10% increase in target based on that, that's 150% return. Just to give you a perspective, if you bought Bitcoin, to get that return, you're looking at Bitcoin going from 60,000 to 150,000 by January, right? I'm just showing you the percentage returns, right? So you're looking at all these different risk assets and trying to think, well, what do I think is more likely to happen, and where is the data that supports it? So that's just giving you one perspective of looking at different data, kind of, if you believe in those estimates, how to, and that's your outlook, then how to kind of go in and start strategizing. So just wanted to give that example.
Awesome job, Demon. Listen, the bell just went off again. Another amazing episode. So much information. The chameleons are super happy with this new fundamental feature. Actually, Liberty says the new fundamental tools are fantastic. Thanks to the MC.
Thank you.
Awesome. Great job, buddy.
All right. Thanks, everyone. Stay safe. Have a good trading day. Hope to see you guys tomorrow.